All right. Yeah, I'm happy to be here again. And I actually do really like doing these live things with people. I know that everyone here is usually like focused on the same. I mean, the reason we do the podcast is the names that everyone talks about on FinTwit. We like to do research and cover them in depth so people aren't just YOLO buying things that they don't know what they're talking about and just deciding to just buy anything that they see on their timeline. And the big thing about that is timing is everything, especially in this market where we've got this value compression going on. And of course, I do think it will regress as everything does, but it's very important now to look at, I guess, the time of the market, like see exactly where the indices are, which index is getting stronger than the other, right? Of course, we've seen the NASDAQ be much weaker than the S&P 500. But as you go down the list, right, we'll talk about the indices broadly, then we'll talk about the bigger tech, which have actually done well, and I'll explain why. Then we'll go through the heads of the table and then some other, I guess, riskier names that people are all interested in and looking at day to day. Once again, shameless plug for TrendSpider. Absolutely love this platform. I mean, it's such a the guy wrote Link if you want to get spicy. I love Link. I always start out the week when I just call it, this is what I'm doing, whether I'm live or not. I'm going through my charts. I'm looking for entries, looking for setups and trying to see what's going to be the best thing for me to be in next week, because it depends on what's really going on the market now. We've got this, the 10 years really scaring a lot of people to where everyone's running away from all these high growth names and getting into this like value safety play. But that doesn't mean that that'll last forever. The same degeneracy that people might have thought was going on with these higher growth names is also happening to these now value names, right? Like people are thinking, well, Carnival Cruise Line is still quite far off its highs. However, like because of the amount of dilution that's happened in the stock, it's still worth about the same in market cap. So things that might look more attractive are actually not as attractive. But to start it out, I always look at the indices. It's the first thing I chart every single week. And so I'll look at the NASDAQ here. And you guys know that the biggest thing I do is this anchored volume weighted average price. So you take the average of every trade every day from a certain point, and it averages out into this nice line to see like this is probably the strongest form of support. And it's all based on volume, right? So if a share was traded at $10 and a share was traded at $20, the anchored VWAP price there is 15. And it just averages that for all the orders over time. And so here's where I started out, is usually news events or like specific times that change in the market for one reason or the other, right? The election here had a big change and caused us to rally. So I'll draw a VWAP here and see, we've been holding pretty well, honestly. We did dip under, but that's always so common to see in these VWAP placements. Like if you could assume it from here, you could assume it from here. But this one is just the closest one to the timing. So you can see here that it did dip under, but very quickly went right back over. And now we're still retesting this VWAP here. So it's important to see, like, if we go under this VWAP, then it's likely that we'll hit the next VWAP, right? So this VWAP is just one place in time. You could theoretically draw one from here. You could also draw one from here. And I've drawn one from here, which is the March 2020 crash. And that has a lot to do with all the new buyers that came into the market right then and there after that big correction. So like once we look at NQ, right, then I'll go and look at the futures for the like US Tech 100 NASDAQ. Then I'll go to the S&P 500. A lot of people trade this because it's easier in terms of dollar value. It's not as expensive to buy and sell because the S&P 500 is a lot more expensive in terms of like if you want to hedge by puts or calls, it's way more expensive than SPY because the SPY is 1/10 the price of the S&P 500. But once again, like the biggest thing I look for besides those volume weighted average price lines are these horizontal line levels. Like these things are very, very important because they usually come in turn, like right on the line of a volume shelf. So one thing I like to do is turn on this indicator, volume by price. So you turn on the volume by price indicator here in TrendSpider, and it allows you to see, well, hey, where is a lot of support here for the S&P 500? And then you can move this at different dates to where, well, hey, like you see this really big change beginning from here. So I like to think of that as like a good place, like June, like almost, like 9 months ago by now. And you see it's actually quite even along here, which is pretty healthy for the S&P 500, is signifying like a broadening formation. And you won't see that same kind of volume by weighted average price in the higher growth names or even in the tech names. But one thing I will say is, interest rates are making the S&P 500 stay up because the S&P 500 is comprised of banks, is comprised of things that are like not just all tech that people think because, rates go up 1-2% that their cash flows for the next 20 years are going to be severely impacted. That doesn't necessarily happen to the banks or the cyclicals. And in fact, like that's why oil went up in sympathy with it. And a lot of the companies are all benefiting energy sector from that. So the S&P 500 is hard to look at, especially for people who are investing in tech names with a longer term outlook, just because the S&P 500 has really not been hit by this. It's there, while there is 27 or so percent tech in the S&P, the rest of it is pretty much benefiting from those different interest rate increases, as well as like, I guess, the bearishness in the tech stocks. So that's a big deal for me to understand, hey, like I want to look at the S&P 500, but not as much as I want to look at the NASDAQ, right? And so I was saying this on Twitter, the days where the S&P 500 are down less percent than the NASDAQ are days where this is being more rotated towards those banks and those cyclicals and energy. And the days when the NASDAQ is outperforming the S&P 500 percent wise, up or down, you want to see the NASDAQ be down less than the S&P 500 if both are down, and be up way more than the S&P 500 if both are up. And so the reason why people are, kind of gravitating towards these bigger tech is stuff like Amazon, Google, Facebook. Those names have not much like damage to get from these increasing interest rates. They all have a ton of cash on their balance sheets. So the main issue for these tech companies is when they don't have a lot of cash on their balance sheet, because then they can actually be in a tough place. Avi, unmute yourself so I don't just talk straight and we can.
Yeah, I was just actually about to jump in. We got a question here from Tito. I'm gonna see if they can just unmute.
Can you hear me?
Yeah, I was gonna read out your question, but if
Oh, okay, thanks guys for doing this. So my question was, at a time when tech is kind of just going up and down and just kind of volatile in general, for trading, like on a weekly or maybe 2-week horizon, do you like shift your focus to more trendy names? Like, the Dow has been doing pretty well. So I've noticed names like Boeing or Caterpillar or UNH, for example, actually having decent price action. So I guess in a broader sense, my question is, when does the leading indices basically inform your decisions in trading short term?
Yeah, I mean, I think it does. I think that it's very clear now that the pressure is on tech, but not all tech. It's on tech that is like, it's a gradient, right? So the ones that have the most cash, Amazon, Google, Facebook, the ones that are less susceptible to issues because of cash squeezes or because of higher rates that they can't pay back loans, like Apple and Google and Facebook, they're the ones that they make loans, right? Like MasterCard, Visa, like those guys are not worried about whether the 10 years at 1 or 1.5 or 2 or 3%. So when I see the indices doing what I was saying last week, where the NASDAQ, right, like on Thursday, the NASDAQ was down 400 and the S&P was like I think it was up or hardly down. You can see very clearly the rotations. And I've realized that there's two ways to play that. A, you can choose to buy things like you were saying, like the Boeings, the stuff that the Dow was at all-time highs and the S&P went over all-time highs last week. And the NQ is like nearly 10% off still. So you can do two things. You can either strongly hedge with individual names that are susceptible to interest rate increases. Like for instance, I'm long CRISPR and Twist and such, like genomics. Those are really easily susceptible to getting crushed because of interest rates, because a lot of their money, they're dependent on borrowing money. They make losses because they're so early in their R&D and development of all they're doing. And so those are the perfect things that I'm using to hedge, actually. Even though I'm still in them, I'm owning them, but I buy puts against those names. And instead of just hedging it 100 shares for one put, I'll do 2 or 3 puts, because I know like if it gets crushed, those puts will make me profit. And then with that profit, it's instead of having to buy Boeing and add more things to my plate that I don't really want to have, because if I own Boeing, for instance, like I don't love Boeing, it starts going down, my mentality is going to be very difficult to deal with, because I wouldn't know if I'm like, hey, do I keep it? Do I get rid of it? It's tough because I don't love Boeing and I don't have any conviction for it in the long term. So that would be like a trade. Yeah, you can absolutely do that. But you can also trade, puts on stuff like the genomics or the trade desk, or Roku, stuff like that. I actually like the CRISPR puts, the Twist puts crush it on a weekly basis. I've been trying to do on Editas as well. It's very, very hard to do that. But, I own CRISPR and Twist stock, and it's easy for me to hedge with weekly options, especially like on Wednesday or Thursday, Friday. the CRISPR options can be $1 or $2, like 3 or 4 points out. And a bad day, they go down 10 or 15, and those puts go 5, 10, 20x, and you've completely covered your position in stock. And then with that, you can allow yourself to put it back into the names that you have conviction in versus adding more to the plate. Like you just pick different portion sizes.
Yeah, thanks so much. That makes sense.
Anytime, yeah.
Tony, I got one question real quick too. It's just talking about the broader indices. Hey, Jeff, you there?
Hey, can you hear me?
Yes, we can.
Okay, yeah, I was just wondering what the indicators on Anthony's SPY chart were, the horizontal gray lines.
Yeah, okay, so I can actually, like, I'll use this to show you one, honestly. So I don't ever just draw random lines. Like for me, it has to have a basis in mathematics, right? Because we know that although there's 25% retail traders now in the market, those guys are usually going off of either just visual representations because they're not that advanced as traders yet to be in the deeper stuff. But eventually, like the easiest stuff for them would be like, you know, the Fibonacci's, the math, this and that. So as a result of there being more traders in the market that are novices, you have to, you know, simplify your trading indicators. And that's kind of what I've been doing. But regardless of that, mathematics doesn't matter whether you've been here for a year or 6 months or 2 months. I always base it in math and then psychological visual representation. So the horizontal lines will be places like, let's say that I start this VWAP from, it has to be from a point that means something, right? So from here, like let's say the March bottom, right? And so if I do that, you can clearly see that there's different areas. And oh, wow, look, you see how 244, well, it's not perfect and it's not supposed to be because math is always subject, like math can be very, very finite. But around the actual answer, it starts to be subjective because, hey, like everyone knows that that's a volume bar, right? So you can see like somebody tries to overshoot it. And so it's called a peekaboo and then it crashes under. And here it's like it didn't get close to it. You didn't think it would make it. And it opens over this line. So that's how you know like the line's value, like it gives credence to the line's ability to actually predict things. But see, that's just one horizontal line I draw. Of course, since this is an all-time high, I'll draw a horizontal line there. And then you see how you've got this range here of like pretty strong. So this is the volume by price. So 150 million were traded between here. 186 million shares, 166, and then it gets less and less. So this is thin. And you know, like, I don't know if you guys remember that chart I posted on Flugent where I said thin air. This is why. So you look at the volume indicators and you realize, hey, it's pretty thin air. If you crack under here, you can stop at this like little base, but if not, you'll stop here, right? Which is coincidentally the VWAP. And so there's always
the obvious stop is the question.
The obvious stop is like, well, the reverse obvious stop is this little thing that peaks above here. And then these are the obvious stops here, this one and this one, because it dips right underneath where this is essentially a volume shelf, right? So if you go under the shelf, you go to the next shelf, which is about here. And that is just to say, if you're in a very, very like recessionary, like a market that's going down a lot, there's still a lot of relative strength, especially in the heads of the table. Plus Square benefits from interest rates. It's essentially a bank. Like I think this is so stupid that Square is down. That's just my opinion. But exactly like what Avi was saying, there's obvious stops all the time. So where when people try to do sometimes random things like, you know, let's start from the POC's point of control here, and we'll just do trend line upwards, right? So you could say, hey, like, oh man, see, this is another example of an obvious stop. You're like, wow, okay, so it held this trend line for 6 months and then it broke under the trend line. Oh, we should sell everything because it's going to the VWAP. But no. This was just the market flushing a little bit. And so that's why, as much as the stock can look good or bad, you have to look at the indices first, because right here is where I posted that chart of the S&P 500 bottoming. So it's like things go hand in hand. Sometimes the indices hold stronger than the specific names. Sometimes the specific names hold stronger than the indices. But you always start at the indices because a stock cannot really go up if the market's down 300-400. I mean, there's going to be few that do, but the majority won't.
Is it because people purely have that psychological stop at a certain number and a round number? Because I remember you saying like, that's what they want you to fall for, right? You know, I'll have a stop loss at a certain time and right. It goes slightly under, knocks out all the people that had stop losses, and then it rockets up. So
exactly. I mean, yeah. That's exactly what kind of happens. I mean, like, think about it. So why do you think Citadel pays hundreds of millions of dollars to get your order flow? Like they know how your psychology works. And it's not just them, it's the entire, like all of it. Everyone knows who's in the game. People pay money to get all that order flow, to understand the psychology behind trading, right? And if people know, like, right, like if you're a really, really like $1 billion fund and you know that there's 25% new traders in the market, and you know, let's like psychologically and also just intuitively where they start. They'll start at the basic fundamental analysis. They'll start at the basic technical analysis where they'll do pennants and trend lines and like the visual things, because people are, I wrote a thesis on this, they're drawn to those visual things. And so that's why those obvious stops exist. They know where to shake out the stops. They know where to shake out the buy stops. Like this always is kind of something that goes with the market. And the more and more people are in the market with less experience, the easier it is for these things to happen. So I think over time, right, like the arbitrage of that closes, because I've seen more obvious stops now than I've seen in my life. And it's because the market is being quite honestly suspicious. Like they're trying to do these things, and it's active retail versus institutional fighting. You see with GameStop and this and that and whatever. And that's just the kind of game we're playing now. So it's why it's so crucial to understand the context between like the indices and between the big tech, the Russell 2000, the S&P 500, then the different types of names that are in bigger tech, right? Like the Amazon, Googles, the Squares, the Fivers, the Etsy's, and then the more riskier names like the Nanoxes and such. Like Fiverr for me, like I think think about this though, this level is not seen since 2 weeks ago. I think a lot of people are overreacting in the sell-off. And that's just because I'm sure people were very levered up here and like, oh wow, Fiverr's going to the moon, everything mean regresses. And look where it caught itself though, this volume shelf, right? So the intelligent thing would be to draw forever line there, because that volume shelf has proven itself at one point or the other. And this continues all the way down to where if you were to draw this line before it was really happening, you would see it stopped here, it stopped here, it stopped here, and then you have this. And this is from High Yield 6 told me, like horizontal lines are really the only things that truly matter besides like volume and prices and stuff like that. And that's very true, because as I showed you just now, you draw an angle of a trend line, I'll draw an angle, Avi will draw an angle, and my chart could be bullish and his could be bearish, but because the like subjective interpretation of something that really doesn't have much meaning unless enough people buy into it.
So those horizontal lines that are drawn here, I know a few people had questions about this. Those are drawn manually or are those automated? I
draw them, yeah, like see, so this is horizontal, or this is any segment you want, and these are the horizontal lines, and then I just click them at spaces where I know like, hey, that's a volume shelf. If it goes under, it'll likely go down to this next volume shelf, which is about the VWAP. If that breaks, it'll go down to the next volume shelf. I think it's kind of easy when you look at it on these two axes. It's upward momentum, and then it's like, where's it going to go downwards? And the same target that you can get for the upside is identical to the downside. And I think people just kind of have a lot harder of a time looking at things going down than up. I know I do. Like I prefer things just going Ripper Magoo all the time. But it's just not always the case. And if you really think about it too, you can kind of see where overshoots happen. And this is like where you draw those random FinTwitty like retail investor trend lines on the top side here. Like this is obviously a huge rally that if I drew this, it would come down to here. So that's 1, 2, 3 touches. And you see like, all right, it's an overshoot. And if you look at the S&P 500 back in September, where the top was at like 35.80, this is exactly what happened. It went over the megaphone, came back down, and right back to the volume shelf. Then it gets some steam here, overshoots it again. And like, I actually sold my Fiverr right here because I was paying attention to this. And I said, well, it happened just now. If it happens again and I get caught again, I'm going to be stupid. And I just started buying back right around here, expecting for this just 25 days or so of downtrend. But once again, really, all it did was regress a move that started in February. If you take every chart pretty much, go back to February 1st or January, it's like if you erase it, you wouldn't know anything happened. If you just like make it go straight to the side, it'll be about like right there. This is where it is a month later. And it's just, you get sick because this happened and this happened. And some people don't take profit here and some people sell it here. And that's just the harder part about trading it. But for me, like this shows me like it's quite bullish. Like I actually am in Fiverr right now. I'm looking to see, hey, like if we can get confirmation over 1, 2, 3, 4, 5 down touches, and over here on this volume shelf is so strong right here at 200. And that's, this one, then this one. The bigger the volume shelf, the number of volume, the better. And if it starts moving, it's easy for me to think, look at the sinusoidal pattern. It'll come right back to the top of this upper trend line. And then when it overshoots, that's when I sell. And it just rinse and repeats.
That was going to be my question, is as it heads towards the bottom of that triangle, if it breaks through prior to the corner there, then you're saying you kind of reset the charts?
Well, if it breaks over here, then I'm all systems go. I'm not selling anything. If it gets up to here, I start dumping everything just because I'm sure that although like, this is okay, if there's an earnings or there's news that caused it to go there, very different because that's a tangible thing versus psychology just pushing it up here. But if we get a reversal, I mean, when we get a reversal, we will have a reversal. We will have a pop at some point. Nothing goes straight down as nothing goes straight up, right? Like this is just the opposite degeneracy of this.
Questions coming in here from Kaza. Can Tony just explain from scratch? Is this automatically drawn by the software?
Yeah. Okay. Here, we'll go over my favorite stock, and I'll start it from scratch. Right, absolute scratch. No indicators, nothing. If you were first day on TrendSpider, this is how you do it. Okay, so first thing I like to do is understand that there's multiple time frames, right? Like while this is an insane, ridiculous move, and people might say, well, you know, C came from $40 to 214. The context of the change of this company is huge. I do not think this is overvalued. I find this very undervalued, to be honest. But regardless, like from a complete chart perspective, you look at, hey, when did this really start to change? When did this start moving like it is today? Like when did it become the love stock that everyone knows about today? And so you can kind of look around and say, hey, logically, this all kind of began in March, right? Like when the March market bottomed, this little gap up here kind of shows me a lot. However, there's something to note here. Like I could put a volume weighted average price anchoring here, which will then take the price and the volume amount traded at that price, averaged out from every day moving forward. So that's all it is. It's saying, I buy 100 shares at $1. Avi buys 100 shares at $5. We average it out, whatever it is, $2,350. It's averaging out to that price, and that's where the volume line will be underneath the average. So that's why you do it the day before, because it is an average. So if you started on the actual day you want, you can't get an average if you start from the day you want. That's not how math works. So you can't do that. But if you look here at March, like there's two different things about SE here. It did begin to get really crazy. However, this is like still consolidating basing pattern, May, April. But you can start seeing the volume of the chart of the bar started getting really crazy right around here. So just for me, I don't mind if it's a few days off. I started from here versus the place at the bottom, April here, because SC is having that aggressive move. And so I know that it would be very hard. Like theoretically, I'll put one here that we can look back in over time in case it breaks this one. But for me, it'd be very, very hard to assume it'll break this one. And under any circumstances, even if the market crashes 1,000 points, like I would be surprised to see SE go back to 40, right? Like at 40, it could buy itself. So basically knowing that the volume average weighted price has been pretty much just trending up the whole time, it kind of tells you that these spikes above, if you're not getting this to spike above with this, granted, the longer you have the duration, the harder it is for it to move up because there's more inputs, right? So the average is brought down, right? You have 100 participants versus 1,000 versus 10,000, right? It doesn't move up each time. Like if SC went to 300 tomorrow, this would not jack spike up. It'll take time because the average is still dealing with 400 other inputs. But this is just the volume weighted average price. And I draw this from many different areas. So right here, you can kind of see a new change in the stock as well, came down and it really went for another big rally. And if I did draw it from here, you can see, hey, well, it lines up here. It lined up here close enough, right? Like I put a feather that shows it like, hey, if it's $1 or $2 off, it could just be that the market turned before this had a chance to get down, or that SC had news that didn't allow it to get down. So people say like, I only trade price. You don't only trade price. You trade price because of what's happening in the markets. And so seeing this, like these are my like ultimate 3 strong supports, right? Like if it comes down to here, like I'll probably load the boat. If it comes down to here, like I will continue to. And like, but that has to do with where the market is. Like if we're just chilling here at rates of 1.67 or 1.7, it's fine for me. Like that's what a healthy market is. Once people digest that and understand that we're broadening, which actually makes the entire market healthier, IQ wins over time. Like people will understand that that's kind of how the market is. And that happens every time we have a nasty correction. The first ones to pop are these leading growth, like these high names that people want to get the juice from. And then we drop and they're the first ones to go. And that's just the way the cookie crumbles. So then that's step 1. You draw your volume weighted average prices, follow that up along with seeing the volume by price, right? So then here you just go to indicators and then you type in volume by price. And I'm just showing you there's 2 different ways to visualize essentially the same thing. So you've got this here kind of, let me start it from the VWAP that I really kind of mentally using for all of this, which is this big start here. So you can see that the distribution of SE is not really bad at all, right? if you were to see this up here be small, like the bar would only go to here and continue up, that means no one has conviction in buying the prices up here. But because there's strong conviction here, here, and like honestly everywhere, you can see the strength of the stock throughout the entire move. And for that reason, that makes the volume shelves even more important, right? So clearly, like, I mean, it's actually, each stock just shows you how much these like 4 or 5 things in a row, like I'll honestly write this out and like explain it, and like I'll put it on the website or something like in the next week or two. But you can see how it's thin air above here because there's not many participants, not many buyers or sellers were right here. And here, this has been a lot more, right? Like this is maybe a week or two. This is 3 or 4 weeks with more conviction because the price wasn't insanium. And usually when the markets drop too, there's stronger volume because it's easier to move a stock up when people are just buying and there's less selling. But when there's selling, there's also buying that are trying to catch the bid and this and that. And that usually leads to higher volume. Like if you look at the volume in the March bottom of the markets, like that'll tell you that. And then we'll go down the list, right? Like we'll see this is the first one. And then, oh, hey, here. Oh, wow, surprising that like that was the top, the bottom, right? Because it's a volume shelf. Then you move down and say, hey, where else can we go? Like, all right, so this is a strong one. It breaks down. It gets to about, oh, well, like, look at that here. Like they're not always perfect, but they're all consolidating in between these areas, right? So, but then I can see here, like the reason why this one doesn't count is because the overall VWAP is here. So mentally, I'll just say, all right, well, the VWAP wins if it's close enough. So that's the next line. So then from here, you can see that there's 1, 2, 3 clear supports on your way down. And this one lines up with the current VWAP, of course, from that start, because see how the timing is here? I timed the volume by price to here, and I timed the anchored VWAP line from here. And they are meant to line up because that's the math, right? But this just shows it to you in a, like, once again, time and change pattern. And this is just the fixed for right now. But this updates every day, by the way. Like if you log in tomorrow, it'll change. And hopefully what you want to see is that these things come in line to where the next shelf is, because that limits your downside. If you can break under the shelf without having both the VWAP by price and the the anchored VWAP line up together, it's more of a likelihood that it'll go to the next one to find some strong support, then bounce from there. But I think SE is going to bounce here. And if you notice the heads of the table, they're all super similar in terms of like, look at this, like it's the same as a fiver chart, right? And so that is essentially all you really need to do to understand like the big basis of the charts, and everything after that is just visual representation. So from there, I'm like, oh, well, this is developing a pattern, and this is, you know, touch to top, and then we'll do another one, top to top. So it's different degrees of importance. If it breaks this, it's a big deal. But if it breaks this, it's a bigger deal. And if it breaks this, it's an even bigger deal. So everything is a gradient.